What's up, everybody? Thank you for tuning in to another episode of the CPA Zone, the podcast where we discuss tax strategies and accounting tips for entrepreneurs and real estate investors. My name is Ryan Pulis, and our company, the Pulis Group, offers tax planning and advisory services for entrepreneurs like you. Whether it's bookkeeping, tax planning, or CFO services that you're looking for, we've got you covered. What's up, everybody? Welcome to another episode of the CPA Zone. Today, we're going to talk about what qualifies someone as a real estate dealer versus a real estate investor and what that means from a tax perspective. So this topic came up over I was having drinks with a few other investors in the area, and we got to talking about this topic. I thought it'd be a good episode to record. So here we are. Now, a real estate dealer holds properties primarily for sale to customers in the ordinary course of their business, while a real estate investor holds properties primarily for investment purpose. They're expecting appreciation over time, or they're holding for cash flow. Dealer property is treated as inventory held for sale to customers, and it's taxed as ordinary income, while properties owned by investors are considered capital assets. So real estate dealers will be taxed differently than investors because dealers' income is typically ordinary, while investor income is capital. So what are the tax consequences of this? Well, one, the ordinary income is taxed at a higher rate. Top marginal tax rate is 37%, while capital gains have preferential rates. They can be taxed at 0, 15, or 20% if you hold the asset for at least a year, more preferential than ordinary income tax rates. Dealers are also subject to self-employment taxes. That's your Social Security and Medicare. It's another 15% on your business income. Investors are not subject to self-employment taxes. There's no self-employment tax due when you sell an investment property. One thing we like to do with our dealer clients is use an S corporation. So the S corporation can help minimize those payroll taxes to Social Security and Medicare. We've talked about the tax benefits of S corporations in the past on prior episodes, so I'm not going to go into the details now, but that's one way to help dealers minimize their tax burden. An investor is not going to want to hold properties in an S corporation because you lose a lot of flexibility. If you ever need to get that property out of the S corporation for whatever reason, then the distribution of the property is actually treated as a sale of the property at the current fair market value is going to have tax implications. You don't want to own real estate in an S corporation, except there are very few circumstances where that's going to make sense. Typically, you want to use an LLC, a single member LLC, maybe you have a partnership if there's multiple people in on the deal with you, but not an S corporation. Now, on the flip side of the tax consequences, dealers are allowed to deduct losses in full, while investors are limited to the $3,000 capital loss limitation, so that you can only deduct capital losses up to $3,000 against ordinary income each year. The excess is carried forward to future tax years. Now, over the last several years, or more like decade, the IRS has really been pushing for dealer treatment when there's gains and investment treatment for losses, because that's more to their advantage. It's to the taxpayer's advantage to treat gains as capital gains and losses as ordinary, because you get to deduct them in full. Now, if you're obviously a dealer or obviously an investor, this isn't going to be a problem. It should be easy to substantiate which treatment's correct. And if it's obvious, you might not get a lot of pushback from an auditor. However, if you fall in a gray area where you're sort of new, you don't have a lot of activity, you want to make sure you have your ducks in a row with proper documentation, or it's really up to you. The burden of proof falls on the taxpayer to prove the IRS is wrong. If they come in and in an audit and decide you're a dealer when you think you should be an investor, you need to prove investor. Now, luckily, some case history gives us a bit of direction on how to classify a taxpayer as a dealer versus an investor. In the 1960s, I believe, there's a case called Winthrop, and from there, we get what's called the Winthrop factors, which is a list of factors that really help us determine whether someone's a dealer or an investor. And each factor is supposed to be equally weighted. Really, there's a few that really tend to weigh more heavily just based on cases that came after. But let's just briefly talk about those factors and what they mean. So first factor is the purpose of the acquisition. What was the intent of the buy? Did you mean to buy and hold it as an investment, or did you mean to buy the property with the intent to resell it for a profit? And if you purchase a property, immediately start improving it, that's going to weigh more heavily towards being a dealer. Buy, improve, quick sale, going to lean towards a dealer. Even if you own it for a while, the IRS is still going to ask what your original intent was at the time of purpose. That's a big one. Next, we have the extent of development work or improvements done to the property. So subdivision, construction of improvements, those things are going to indicate the property is held for sale in the ordinary course of business and lean more towards dealer treatment. Next, we have the nature of the taxpayer's business, including other activities and assets. So what's the nature of the business of it? What's the business code they use on their tax return? What does their business do day to day? For an investment, you might have a one-off property as an investment. Is that mixed in with a bunch of properties that you're buying for sale? If so, you really need to prove why this property is different. Maybe it was a rental for a while and it just wasn't working out. And then you decide to sell the property. Well, that's going to help indicate investment status. Next, we have use of a business office for sale. So are you a broker, or do you have a license to do this on a regular basis and the proper permits? If so, capital gains treatment is probably going to be denied. It's more likely you'll be treated as a dealer. Again, that kind of comes back. It's similar to the nature of your business. Now, that doesn't mean, for example, if you're a real estate agent or a real estate broker, that the sales of the properties you own as investments are automatically taxed as ordinary income. Again, all the factors are considered. But if you're a broker, then and you're selling properties that you're developing, you have or maybe you just have a broker or someone on staff that's selling it. Having that business office designated for sales activities is going to lean more towards the dealer status. Now, the next factor is the method the taxpayer uses to sell the property. It's also very significant. So if you're more aggressive in marketing and sales, that's going to point more towards dealer status. And it's somewhat related to this having a business office for sales. So the advertising, use of brokers or agents, or substantial personal efforts to make sales, those are more indicative of a business rather than an investment. How much time and effort did you put into the sales? More sales effort can tip the scales towards dealer status. And that doesn't mean you can't use a real estate broker or real estate agent to sell your investment properties. Obviously, a reason you want to use someone like that is that they're going to help get a better price. It's just, again, it comes down to all the factors played together and how aggressive are you marketing and advertising and putting time into sales of properties. Dealers are going to do a lot more of that than someone selling an investment property. Next, we have the purpose of the owned property at the time of sale and the duration of ownership. So a longer holding period is generally going to give a little bit more weight towards being classified as an investor versus a dealer. Dealers, they get a property and they want to sell it quick. They're selling their inventory. They want to turn that over as many times as they can during the year to increase their profits. And again, the classification as an investor or dealer, it's determined on a property by property basis. So you could possibly have both. You could have properties that fall in this dealer classification and others that are treated as investments. So it's a case-by-case basis. And then last, we have the number, frequency, and continuity of sales over time. How often are you selling properties? Some people will say that 1, 2, even 3 sales per year will keep you safely in the investor box, but that's not necessarily true. You might not get flagged for an audit as easily with a handful of sales a year, but it's still going to come down to your intent, how and all the other factors, including the number and frequency of sales. So it might take you a few years to improve and sell a property that is still technically treated as inventory and should be looked at as being in dealer status. So again, all these factors need to be considered together. It's not, no single factor is necessarily going to make you a dealer or an investor. They need to be looked at together. There was a case in Byram. So the court found that this taxpayer had 22 sales over 3 years. And the court decided that's a substantial number. However, the taxpayer is not considered to be in the business of selling real estate. So these were treated as investments. And a big reason why is because the buyer of each property, initiated the sales. The taxpayer in this case they didn't subdivide the land. They weren't advertising. They didn't spend very much time or effort making the sales. So these were all things that lean towards that investor status. So again, no single factor is conclusive by itself. Each case needs to be decided on the facts and circumstances. While each factor is taken into consideration and they're supposedly all equally weighted, other tax court cases since the Winthrop case have given us a bit more. They're focused more on a few. It seems like the most weight is given to that last factor we discussed, the frequency and number of sales over time. That tend to be the most crucial factor. And next is the original intent of the acquisition. That's also a big one. Each case is going to be decided on all the factors, but these two tend to have a bit more weight. So it's very important that you have a plan in place to document your intent up front. That's something a CPA can help you with. If you work with one that offers tax planning, in your tax plan, you could have documentation or a write-up of here's what you're planning to do, here's what we're hoping to achieve. Or if you prefer to do it yourself, you draft your own plan, do it up front. Something you could discuss at your board of advisor meetings and include the highlights in the meeting minutes. Good documentation is always key when you're dealing with the IRS. So again, there's tax consequences to being classified as a dealer versus investor. Dealer income is taxed as ordinary, also subject to self-employment taxes, while investor income is taxed at the more preferential capital gains. If you own it for more than 1 year, short-term capital gains are taxed as ordinary, but no self-employment taxes on the investor side. And on the flip side of that, dealers can deduct their losses in full, while investors are limited to capital losses, can only offset capital gains, and then you're allowed to use $3,000 a year against ordinary income, the rest rolling over. So that about does it for today's discussion on dealer versus investor status. I hope you found value in this episode. If so, please leave us a 5-star review or hit the like and subscribe button. Until next time, have a great day.
This audio segment was edited by me, Adam Rothstein. If you would like help editing your podcast or narrating your audiobooks, please email me at adamrothstein29@gmail.com. That's ADAMROTHSTEIN29@gmail.com.
So that about does it for this episode of the CPA Zone. Thanks for listening, and I hope you found something valuable that you can take away. We are taking on new clients, and if you'd like to work with us, then go to our website and fill out the client intake form on our contact page. This can be found at thepulisgroup.com/contact. That's THEPULICEGROUP.com/contact.